Top Biden officials panic. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, while America focuses on last night's debate, what happens next will shock the nation. And if you think the Biden administration is in crisis mode now, as you're about to see, things are going to get much worse. Now let's head over to Bloomberg, where we picked today's story up with a headline as Biden's disastrous debate accelerates doubts over candidacy. And this is only the tip of the iceberg. And what I want you to understand is based on the data we got today, things for the U.S. economy and for the incumbent president are going to get far worse and very quick. One Democratic lawmaker shortly after debate, speaking on condition of anonymity, said the president appeared to be a shell of his former self and that the party must have a conversation about replacing him on the ballot. And while this is actually a rare event, it has happened in the past. And could there be a catalyst that gets President Biden to step down from running for a second term? Well, perhaps it's coming, and soon, as Trump, who polls show with a small but steady lead heading into the night, now appears a clear favorite to capture the second term in the White House. It was really disappointing debate performance from Joe Biden. I don't think there's any other way to slice it. This from Kate Bedingfield, the president's former communications director, who said on CNN, I'd love to know what you think. Who won the debate? Was it President Biden or former President Trump? Weigh in the comments below. His biggest issue that he had to prove to the American people was that he had the energy and stamina, and he didn't do that. But was that the only problem here? Because remember, consumers and voters, they actually go to the poll with their wallets when things get tough, and things, as you're going to see, are getting far worse in a way that the political elites cannot see. It's going to cause a crisis that's going to make America forget all about last night's debate. Maria Shriver, the sign of the Democratic Kennedy dynasty and one of the First Lady Joe Biden's guests at this year's State of the Union, said tonight was heartbreaking in many ways. There's panic in the Democratic Party, she said on a post on X. It's going to be a long night. Indeed, it was. But one thing it shouldn't be a long night for, that's our subscribers, as they're watching their brokerage accounts go higher. As U.S. crude oil heads into the third straight weekly gain as fears grow of Israel, Hezbollah war. And if you want to make money trading, you want to be a better investor, we give you all the tools. And this from our CTA Timer Pro Report. We look at the machine positioning every day, and when we see them in deep short position and price rallies against it, our reports say you should buy. And now we give you all the details, what I think of the upside targets, stop losses, and we update our trades on a regular basis. And look at this. Had you followed our report back on June 12th, here you are 15 days later, you'd be at 4.02% and looking to see your account go even higher. Here's the best part. There's a 30-day free trial. Links in the description below. My buddies who sell trading reports, they don't even work as good, and they don't even give you a free trial, if you can imagine that. That's how confident we are, as Democrats are strongly urging the White House now to ask Biden to step down following last night's debate. And according to CNN's John King, there will be a mad last-minute scramble to force him off the ticket. And he said a deep, a wide, and a very aggressive panic in the Democratic Party. It started minutes into the debate, and it continues right now. But again, this is only the beginning of what is to come. And right now, people are focused on this, and they just can't see in a matter of months the attention of the American public will be elsewhere. And of course, he's not dropping out. This, according to campaign spokesman Seth Schuster, he echoed, of course, Biden's comments saying it's hard to debate a liar. The New York Times pointed out he lied 26 times. Biden noted he's committed to the next debate in September, and by the time we get there, the picture for the U.S. economy is going to be outright disaster. There's not just going to be panic in the White House, there's going to be panic in the American public, and we got some more evidence of that today as the Fed's favorite inflation gauge slows, supporting case for a cut. But what it's really indicating is demand for the U.S. economy is in decline now, and this is dangerous. Any incumbent president that faces a recession is highly unlikely to get reelected. This is going to be all-out chaos because people are going to be very, very unhappy. At the same time, household spending rebounded after a pullback in April, and income shows solid growth, offering some hope that price pressures can be tamed without lasting damage to consumers. And this is giving some hope, at least that's what the data wants you to believe, is that incomes went up, and that means everything's going to be okay. But what we can't see, because he didn't talk about it in the article, is demand is going down. And here you can see the evidence that while personal incomes were up 0.5% in May, personal spending was only up 0.2%, and it's quite normal that we see the exact opposite, where spending outpaces incomes, and that's the American way. We borrow and spend more money than we make and worry about that issue later. When you start to see a change in American savings patterns, well, it says the economy is all but headed into a recession, and we know if it does, the banking system is not resilient enough, and what means we're on the verge of an all-out financial crisis. The people will be looking back at this debate and they'll forget all about it, as a so-called core personal consumption expenditures price index, which is the Fed's preferred inflation gauge that strips out volatile food and energy items, increased 0.1% from the prior month. That marked the smallest advance in 6 months. And so while we continue to hear that inflation is going to kind of rear its ugly head again and consumers really buy into that narrative, the data suggests exactly the opposite is happening here. And on a 2 decimal basis, it was only up 0.08%, the least since the late of 2020. And of course, that means we are now likely to see a drop in demand start to show up in the data. And there's a very good reason here. This means consumers are tapped out. They're looking to start rebuilding their savings, and that is not what the White House wants. They need a booming economy, at least to make the case for a second term, as inflation-adjusted consumer spending growth was driven by goods and fueled in part by the jump in incomes. The combination of slower price increases and robust spending offers some relief for Fed officials after an array of reports earlier this week pointed to a loss of economic momentum. And yet, it's interesting that this is the view, because what do we hear from companies like McDonald's and Burger King and Taco Bell, Walmart, Target? They're saying consumers are tapped out, that they're looking for value, they're cutting their spending, they're not even showing up, and when they do, they spend less. They're not focused on discretionary high-ticket items. So it would indicate that even though on a month-over-month basis incomes went up, demand for the economy has gone down. And what would actually make that change? Well, what happened recently is insurance premiums went way up, along with gas prices. And so even though incomes are higher, consumers, well, they're not feeling rich at all. And here we can see some of the evidence of what's going on here. We talk about total compensation. This is average hourly earnings multiplied by average weekly hours of production in non-supervisory employees. And you see that in blue. And we're looking at inflation-adjusted retail sales, and that in red, both on a year-over-year rate of change. And notably, when you see consumer incomes start to decelerate, well, what happens is they end up spending less. And right now, we're championing a 1 month-over-month print to say, look, everything's okay. But the reality is the market can't understand there were other expenses that consumers had to face. Again, rising insurance costs. We saw higher fuel prices. Maybe there are some other things. Weigh in the comments what you're seeing go up that the reports aren't telling us. And what happens is demand is continuing to decline. And we see this effect largely going into recessions. Now, back in 1994, when I was graduating high school, we had a mild recession. There weren't quite as many jobs, although they were still somewhat plentiful. But look what happens going into the dot-com bubble. And again, in the global financial crisis, you see a very clear indicator that we head into a recession. Now, we almost had a double dip following, of course, the global financial crisis. And look what's happening now. Retail sales are on the decline. And when that happens, retailers start to cut hours. They cut new orders. They start to let people go. And sometimes when people quit, they don't hire employees back, giving, of course, more pressure to the existing workforce. And this doesn't turn out into a booming economy. It turns into a recession. And the economy is moving in the right direction. Well, it depends on what you think the right direction is, with persistent growth, moderating inflation, and a more normal balance in the job market. And I couldn't disagree more about the job market, and I'll show you why. I think Bill Adams here, the chief economist at Comerica Bank, is totally wrong. And this is the kind of good data that will persuade the Fed that inflation is headed back to normal. Well, the data suggests inflation is headed back to normal. Keep in mind, the Fed's target here is 2%. And what it means is demand is going down at a time supply is going up. The issue we should have focused on is raising supply. Of course, the Fed has no control over the factories. That should have been the goal. The problem now is supply is going up and Fed has crushed demand. And Treasury yields initially fell after the report as investors priced in a greater chance of cut, and then panic hit the bond market, sent yields higher, perhaps maybe on the fact that there's some concern that President Biden will drop out of the race and won't run for the second term. Of course, what comes here, maybe by September, could be the reason he steps aside. And it might be for good reason, because if the economy hits into recession, well, the odds go to zero anyways. But look at this. When you see personal consumption expenditures, this is the Fed's preferred inflation gauge. We talked about the core there, and they're one and the same. One strips out food and energy. This includes it. And against 10-year Treasury yields, what I want you to see is demand in the economy goes down. Again, showing how the blue line, the PCE on a year-over-year rate of change, goes down. Yields tend to fall. And it makes perfect sense, because you think about a debt-based economy. If you have a business and people aren't coming in and spending, and well, higher rates would not really incentivize them to do that. But if interest rates go down and banks extend credit, well, then consumers would think, well, my payment on that wouldn't be so bad. They would come in and they'd consume. And that's the key part here. And this is why you see in a debt-based economy, rates tend to continue perpetually go down, because it's all about demand. When you need to juice demand, you cut rates. Well, this time the market says otherwise. But look at all the relationships here. You'll notice personal consumption expenditures declines, rates go down. And you see that event pretty consistently, except for now. The Fed thinks rates need to stay up, and the market thinks so too. And all they're doing is setting up disaster in the months to come. When rates are too high, they crush whatever little demand is left in the economy. And by then it'll be too late. Everyone thinks a cut by the Fed, maybe one or two, will change everything. It's going to be too little too late, because it's the labor market, as I'm going to challenge Bill Adams' statement here, that is going to go wrong next. And here you can see the evidence inflation is on its target. The PCE and the core, again stripping out food and energy, are down to 2.6 year over year. Remember, the Fed's target is 2, setting up a possible cut in the months to come, putting some question to the market's shock reaction in bonds today. And the deflation in goods prices and weakness we're starting to see at least gets us the path to a possible September cut. I agree with that, absolutely. And central bankers pay close attention to services inflation, excluding housing and energy, which tend to be more sticky. That metric increased a mere 0.1% in May from the prior month, again showing across the board, everywhere we look, that inflation is cooling off. Maybe the year-over-year numbers aren't coming down as fast as everyone wants, but if we continue to get these low month-over-month prints, inflation indeed is coming down. And despite some signs of cooling in the labor market, well, they're more than just some signs. We're seeing more than that. Solid wage growth continues to power consumer spending, but that's only, here's the key part, for the people that have work. So that's one thing, of course, you look at the data and you can't get it. They don't understand. If someone loses their job, their spending power goes down. It doesn't matter if the person who kept their job sees a little bit of a wage increase, is not enough to offset the loss from the other employee. And here we see wages and salaries rose 0.7%, and on an inflation-adjusted basis, real disposable income jumped 0.5%, the most since January 2023. And despite that, consumers aren't spending. Again, they have other things that are impacting their budget, higher fuel prices, higher insurance prices. It doesn't matter. It's not enough. They wish their incomes were higher, but it just isn't good enough. And what that's going to lead is an increase in the savings rate. Here you can see PCE still shown in blue against the personal savings rate shown as a percentage, that in red. And what do you note? When consumers decide to start saving, and they tend to do that when their savings rates get fairly low and they start to lose confidence about the economy, what happens is personal consumption expenditures decline. And this happens each and every time consumers start going on a savings binge. And it makes sense because they're offsetting what they would spend in the economy to rebuild their savings. They're doing that because despite the fact that incomes are rising, hours work are getting cut. People are indeed losing their job, and that means, of course, consumers looking to start saving for that emergency time that's coming, which we know is a recession. And what that indicates, of course, is personal consumption expenditures are going to continue toward the Fed's 2% target, considering the savings rate is still relatively near all-time low levels, giving means consumers not only are they struggling with inflation, they have absolutely no savings to fall back on. That's going to hit the economy in a big way. And here you can see the savings rate rose to 3.9%, the highest level since the start of the year. A monthly government report on unemployment due on the 5th will offer the latest insight on how income growth is holding up. Of course, we doubt that that's going to hold up, as we note from the regional Fed surveys that hours worked are getting cut. And of course, it's the weekly jobs data. And so this is where it comes back to the beginning of the show. We talk about what, of course, the Biden administration is really going to be worried about. What's going to shock the nation as we head into a recession. Could be that President Biden is one of the few presidents that steps aside, let someone else take the ballot in November. We'll be curious to see how this plays out. But one thing we do know, if continued claims continue to tick higher, well, what you can see is a beautiful relationship between the personal consumption and expenditures and, of course, unemployment claims. You'll note that in periods where PCE is in decline, well, that means, of course, the labor market is seeing an incline in people on unemployment that are getting stuck there. We note now that every week continued claims are ticking higher a little by little, and at some point it's going to accelerate to the upside as initial claims chase it higher. When that happens, it's game over for the U.S. economy. And if you want to see real chaos and real panic in the White House, well, wait till that happens. Until then, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.